Last week, the tailwind was in all of the headlines about the billions and billions of dollars of AI infrastructure deals, the United States and the Gulf nations, NVIDIA, Supermicro, Dell. But that's the area of weakness this Monday morning. Is it just a little bit of a reality check on how soon some of that investment will be felt?
It's a good question, Ed. It may be a reality check. It may just also be profit taking. We went from overbought to severely oversold to overbought again within just about the span of a month. So the tech sector in general has had a very strong run recently, and we can talk more about why that's the case. But I think investors are just looking, saying, okay, we can take some profits at this point.
Well, in part of why that's the case is earnings, right? I think we're still a little bit digesting what the net takeaways from the calendar first quarter earnings were. Sure. What were your main takeaways from that period?
Sure. Well, first of all, I think what was notable was just how resilient Q1 results were. And it wasn't just in Q1, it was in the subsequent weeks through to the quarterly reports. And that encompassed a period of tariff-related headlines and uncertainties. So that was refreshing and encouraging. And it wasn't just AI or a series of AI proof of concepts at the expense of all else, which is largely what it felt like last year. It was AI strength plus real core business strength, and that was refreshing. Now, we're coming up upon April quarter earnings reports, and I could imagine that some of those companies who would have had to close their quarters in the midst of tariff uncertainty might see some variability, might have seen some pausing in spend, but overall, the underlying results are very encouraging.
What I found super interesting about that earnings period in technology is you have like primary data and secondary data. The primary data, like the commentary and what's in the earnings statement. But some of the secondary data we were tracking, for example, in the AI infrastructure space, was leases, data center leases. And that caused all kinds of noise going into the prints. And we had to decipher what it was that was the truth, based on executive comments. How did you navigate that set of data?
Tons of noise in the space. That was probably maximum noise that we've seen in a long time. But it's fascinating. Starting with the underlying demand trends, you saw hyperscale vendors reaffirming CapEx plans. You saw some of them increase them. Microsoft in particular talked about rising near and long-term demand signals, which could actually cause them to prolong their investment in long-lived assets, meaning land and buildings, which they've been engaging in over the course of the last 18 months at least. So how do we marry that up with data center lease cancellations? Well, it's interesting. Microsoft in particular makes a lot of use of leases. They came from behind relative to the strong demand signals they're seeing in getting that requisite capacity to be able to fulfill AI and other demand for the next 5-10 years. So they were building rapidly. Within that, they signed a ton of leases across the globe, which was a brilliant strategy, by the way, because it froze some of those opportunities to competitors. And then within that, I think they decided that they didn't want to be the sole source of training for OpenAI. And also within that, there were power constraints. And I think they realized that these leased facilities wouldn't be up and running until 27 to 2029. And in that vein, they could actually shift to some degree to own data centers as well as leased data centers. And you're seeing that kind of across the board. But in the end, some of the data center lease capacity we were hearing was 5x what you were seeing signed on for by an Amazon, for instance, or the rest of the ecosystem. And last time I checked, Microsoft wasn't 5x the size of an Amazon. So basically, they were giving themselves optionality. And in retrospect, they're still building and there's still demand.
And again, a part of the higher CapEx reflects the higher cost of doing business because of the impact of tariffs to supply chain. Yes. I've been thinking a lot, as one does, about year-to-date performance of the hyperscalers. And it's interesting, right? If you just say hyperscalers, Microsoft, Amazon, Alphabet, Microsoft's stock is up more than 8% year-to-date. Mm-hmm. The other two names have been under pressure. We, of course, kick off with Microsoft Build. But we also talked last week about some of the difficulty Microsoft has in reaching its own goals because of its relationship with OpenAI. This is something you've been thinking about as well.
Yes. Well, first of all, with respect to relative performance, I think you're almost seeing from a cloud perspective in the other two what we saw with Microsoft toward the end of last year and early this year, which is that they're behind in getting capacity, and that is constraining cloud growth. So it hasn't been a demand issue, it's been a supply issue. Second of all, Microsoft has been very tethered to OpenAI. They've been diversifying, but the two are quite aligned. I'm not sure I view it at all in terms of their not being able to realize their goals. I think their goals are to focus on their own compute capabilities for their customers and to add in OpenAI and other LLM vendors, but especially OpenAI as part of that equation. I think it was a deliberate decision not to focus solely on training. That would have crowded out a lot of the other exciting and high margin endeavors Microsoft can engage in its core customer base. And in the meantime, it's a highly symbiotic relationship. Microsoft's infrastructure was originally built in AI to around OpenAI and the related infrastructure. It has InfiniBand throughout. It has some tremendous capabilities, and I believe the two companies want to continue to work together.